Hi Jenny, how are you?
Hi, I'm having some problems with my laptop. I don't know what's wrong with it. So
Uh-huh.
I'm actually using my phone. I'm using my phone right now.
All right, but can you manage the screen there?
Yeah, yeah,
Okay. So long as you can hear and so long as you can manage the screen, it's all right
yeah,
because
yeah.
I'm recording the lesson and I can send you the
Mm-hmm.
link later on.
Yes, please. I'm
Yeah.
so sorry I'm late. It's because the laptop is just, I don't know what's wrong with it, man.
All right. Okay. Maybe I don't know. Sometimes what is your system? Is it Windows 10 or 7?
Yeah, I think it's the new one.
All
It's the
right.
new one.
Okay, yeah, because sometimes the new one, what happens is it goes for updating for a long time. If you don't use it continuously, it will, the moment you
Yeah,
start, it will start updating and it won't work.
yeah, maybe that's what's happened.
Yeah, anyway, don't worry.
Yeah.
We will try to manage
Okay.
because I don't have calculations today, lot of theory. So we should be able to
Yes.
manage it.
Okay.
Basically, yeah, I think it was 6 hour today. If you remember my syllabus plan, we want to do in the first 6 hours the business taxation, the conceptual framework. We have done that one. Today we must try
Mm-hmm.
and do the external audit, code of ethics, corporate governance. Those are the areas what we
Mm-hmm.
need to cover up. So
Okay.
lot of theory stuff, but F1, as you would have seen in your papers, there is lot of theory along with your calculation.
Yeah.
First of all, let's talk about the external audit. Now, you remember we said the accounts are prepared, the financial statements are prepared mostly by the accountant. You and I, we are the people who prepares the financial statements or a company. And we are
Yeah.
governed, we are sort of we are covered by the framework what we discussed last time, and also by the accounting guidance given by the international accounting body. And in fact the
Yeah.
framework is there just to support the international accounting standard body to set up the accounting standards in line with the framework. So framework is the frame as it says. It is all about that one. So we accountants, we prepare the financial statements in line with all that. However, even though we prepare, the board of directors are legally responsible for the preparation of financial statements. We do have a responsibility, but if it comes to a court case or something, the directors are legally responsible, including non-financial directors. Everyone is collectively responsible for the preparation of financial statements. So they can't say, I don't know, it was prepared by Jani, it was prepared by Kuma. They can't say that. They are legally responsible because there were a lot of frauds happening in 1990s, and finally it was decided the board of directors must be placed the responsibility for the preparation. Now, why
Yeah.
do ultimately the financial statements are prepared? To give information primarily to the shareholders. Shareholders are the owners of the company. They are the people who have put their money into the company. So they must know whether the company is performing right, well, all that, and that information is what is ultimately they say in those financial statements. Having said that one, the directors are preparing, directors are managing the shareholders' money, and therefore it is necessary some independent party, independent of the officers of the company, independent of the directors of the company, will go through those financial statements and tell whether those financial statements are prepared in accordance with generally accepted accounting principles, the framework, international accounting standards, and what ultimately they say is whether the financial statement shows the true and fair view of the affairs. So for that purpose, we have to have, in addition to the directors, the accountants, and the shareholders, some party called a third party, independent party, called external auditors who will just look at our financial statements which are prepared, and finally they will give an opinion. Remember, they are not preparing the statements. They are the people who will give an opinion about the finance. So CIMA does not too much focus on audit and all that. ACCA focuses on audit, Chartered focuses on audit, ACCA focuses on tax, Chartered focuses on tax. CIMA, only at this level, they will test us on audits and they will test us on taxation.
At the next level, they don't do that?
No, they don't. They don't. Because at this level, we learn the basics of the audit and all that. We don't go beyond this one. We are essentially Chartered Institute of Management Accountants. We are almost internal information providers. We get associated with the preparation, but generally that part of the job is done by members of the Chartered Institute or members of the ACCA. So we don't go too much into the audit and that areas because in Chartered you have big papers in auditing, ACCA you have big papers in auditing. We don't have. In this particular F1 subject, they test us and that's all.
Okay.
Right. So let's talk about external audit. So as I said, it is an independent expert examining and checking the financial statement. So who are the experts to check the financial statement? Obviously, they have to be accountants, isn't it? Doctors can't check the financial statement. So this is why we call the auditors, the audit firms. The big firms are like KPMG, Ernst & Young, PricewaterhouseCoopers. They are the big firms. And there are thousands and millions of small audit firms. Only accountant or accountants can get together and open up an audit firm, what we call an accountancy firm. And even CIMA members can do it. But CIMA members, if they do it, they have to, the local body will have to permit them to do it. But generally, Chartered ACCA members are recognized to do the audit work. So it is an independent examination. They check the financial statements, and after examination, they will have to prepare a report. They will prepare a report to be present to the shareholders. So remember, the auditor's responsibility is not to the directors, but to the shareholders. Because it is directors, it is the shareholders' money, directors managing, and therefore the auditors must report to the shareholders saying that, is there any, can you hear me?
Hello?
Yeah. I think,
Can you hear me?
Yeah, there are two speakers. Yeah, now it's all right.
Yeah, it's okay now?
Yeah, now it's all right, yes.
Yes, my laptop is up. Okay, perfect.
All right, okay, yes, all right, okay. Right. I'm sure that it would have got updated something.
Yeah.
Right. Okay. So after the examination, the auditors will prepare a report to be present to the shareholder. So these are the type of questions you might find in your paper. The examiner might ask whether the report will be present to the directors or whether the report will be present to the shareholder. Remember, the report will be presented always to the shareholders.
Right.
So it is always to the shareholders that the auditors will report. Of course, they can't go and meet all thousands and 10,000s of shareholders. They will give the report to the directors to be circulated to the shareholders. That's what the annual report is. All the financial statements along with the auditor's report, along with many other information are put it into one book. Most nowadays it's a CD and it is distributed to the shareholders. So what is the objective of the audit? Is for the auditor to express an opinion. So remember what he expresses is an opinion. Opinion is not a final conclusion. he reads the financial statements and he will see whether the financial statements are fairly presented. So what he says is whether the financial statement shows the true and fair view. True and fair view. I remember a long time back in Sri Lanka, we said true and correct view. That is not right because no one can say whether it is correct or not. But we can say whether it is fairly presented, right? Because when you prepare financial statement, it's like an art. It's not a science where you will have only one particular answer. Hello, 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 hello.
Yeah.
Can you hear me? Hello, hello.
Yeah, I can hear you now. Yeah.
Okay. Right. What I said was,
Hello.
hello, 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 hello. Hi, hello, hello.
Yes, I can hear you.
Okay. Right.
Yeah.
What I said was the auditors will give an opinion. The report is an opinion, not a conclusion. Remember that one. So you can't take the auditor's report and say that something has gone wrong, something is this thing, that thing. It is just an opinion. You may have to further investigate. Now we go to a doctor. Doctor will give us an opinion. But if you want to do further things, you have to go through the opinion and do further examination. So that's what the auditors will do. And finally, the auditors will say whether it shows a true view. True means an accurate view, and a fair view. Fair view means an unbiased view. It's not prepared to please any particular party. It is the unbiased. Remember SIMA Code of Ethics, we are supposed to be objective. So when we prepare our financial statements, it must be unbiased. The financial statements, the auditors will say whether they have been prepared in accordance with specific legislation. Now in UK, there is the UK Companies Act or the Companies Business Act, which says the account should be prepared in this manner. Sri Lanka, we have our own companies law. So different countries will have different law. The financial state must be prepared according to those laws. Finally, as I said, the purpose is when the accounts are audited by an outsider, expert, and when he says financial statements in his opinion are all right, that gives lot of confidence about the financial statement. Because some third party has gone into the depth of it and says it is all right. If they say it is not all right, something is not really right. So, as I said, it's an opinion and therefore it's not 100% guarantee, but it's a fairly reasonable assurance. You can't hold the auditors responsible saying you said the statement shows true and fair and now something has gone wrong. You can't hold the auditor responsible like that. But if the auditor had been negligent in performing his function, then of course he will be taken for task. And if audit has been deliberately involved in a fraud or something like that, then they will be taken for task. So remember in 1992 when that famous company Enron collapsed, even the auditor was sent to jail because the auditor was very much directly involved in the fraud. You are not supposed to do that kind of a thing.
Yeah.
So what is first of all, before we talk about the rights of the auditors, let's talk about the director's duty. So directors, typically in most of the companies, they are responsible to safeguard assets, prevent frauds and errors. The reason, shareholders have put their money, and with that money, the directors have bought certain assets, property, plant, equipment, inventory, etc., and therefore they must safeguard those assets. So they must take proper controls to ensure that the assets are properly maintained, properly cared for, and properly used for. And also in companies, we find lot of frauds happening. The directors are responsible to prevent frauds by putting right internal controls. The directors are responsible to ensure that the financial statements are free of material errors. You remember when we were discussing the conceptual framework, we discussed about the materiality. It should be free of not little errors, but of big errors it should be free. And for that purpose, they must employ qualified people like CIMA students, CIMA accountants, so that the financial statements will be prepared with free of errors. And directors must ensure that the entity keeps proper accounting records such as ledgers, such as cash books, bank reconciliations, prime entry, whatever that you have to keep it, that they will be properly maintained. Remember, all these things are done by accountants and the account staff, but the responsibility is with the director. So the directors must see whether the accountants are properly doing these things. If they are not doing, ultimately who will have to go to jail will be the directors. So don't become a director unless you are very sure that the company that you are working is having proper controls and everything, because the directors can get into a lot of problems if the company is not properly.
Okay, thank you.
Yeah. Those days, becoming a director was such a prestigious thing. But today, becoming a
No, it's a
director,
hassle, it's a stress.
yeah, it's a hard-taking thing. You have to be very, very careful where you accept the directorate. Whether it's executive directorate or a non-executive directorate, if you are a director, your liability, your responsibility goes all over, and the moment it is tarnished somewhere, your reputation is gone. After that, you can't find a job even elsewhere. I worked in a company 7, 8, 9 years back. I left a company. I was the finance director at that time. I left it about 9 years back in 2007. Recently, some fellow is coming and asking me, are you so and so? I said, yes. Did you work in this company? I said, yes. Were you a director? I said, yes. Then he said that, the company has not paid the taxes and something. And they want to issue summons on me to come to court. I asked, when has this happened? So then they said it has happened 2010-11. So I said, sorry, I was not there as a director in 10-11. I was there director as in 7. So you can see, even after you leave the company, still you may be subject to certain things. You have to be very, very careful becoming a director. And the directors are responsible for the preparation of annual statements. Not that they will prepare, but you remember we were talking the financial statements, 5 statements: statement of financial position, statement of profit or loss, statement of cash flow, statement of changes in equity, notes and accounting. All those are prepared by accountants, but directors are responsible. And
Because they sign them off, don't they?
they sign it. They sign it.
Yeah.
They have to sign. 2 directors have to sign the financial statements, and there are certain regulatory authorities looking after the company's financial statements. The London Stock Exchange. Then there are some regulatory authorities. Now Sri Lanka, it is, I think there's a accounting board or something like that. You have to send your copy of the audited financial statements. They also will go through that one and see whether the statements are all right. You must set up the internal control system. The directors are responsible to prevent frauds and errors. And for that purpose, directors must set up good internal control systems to ensure that all requirements are met. So you can see the directors' responsibilities are very, very heavy. And simply 7 directors, 8 directors, 9 directors, 10 directors can't do it by themselves. So they get assistance from another party called internal auditors.
Internal auditors?
Internal auditors, yes.
Oh, okay.
So we are talking about external auditors. External auditors are outside the company. They are third party. They will come and do the work. but we can have an internal auditor inside the company who will work as an employee of the company, who will look at, because he's also accountant, he will have a big department. He can support the directors to ensure that the controls are there.
Right.
So that is the tool, the arm for the director's support. So they must have a proper good internal auditor who will walk around the company, will look at and tell, hey, in this area, the systems are not good. In this area, systems are all right. So there's an internal auditor. He's also an independent person, but he's part of the company. Right? So you can see the director's responsibility fairly big. Now we come to the duties of the auditors. What are the duties of the auditors? So we spoke about the duties of directors. Now I'm talking about the external auditors. What are their duties? So primary report duty of the auditor is to report to the shareholders whether or not the financial statements have been prepared and whether it shows the true and fair way. True is accurate, fair is unbiased view, and in accordance with the applicable reporting framework. That is the conceptual framework what we discussed, and maybe the accounting principles, all that kind of thing. By exception, now you have to remember this one, they are under duty to report any problems to the shareholder. It is not their main job to go and find frauds and errors. But in the course of the audit, if they come across a big fraud or a big error, they must report it to the shareholders in the form of the audit report or in a different report. They must. It is not part of their main job. Main job is to look at the finance, but in doing that, if they come across something, they can't just have a deaf ear or a blind eye. They can't just turn and say it's not my thing. If they come across something, they must report it to the shareholder. So basically, they will look at returns from branches have been received. Now, if it's a bank, you will have many branches. So when you are doing the head office audit, you must see whether you have got the correct returns from the branches. If there are branches in a company, subsidiaries, you have to see whether those things have been properly audited, because the parent will prepare consolidated financial statements and the auditor will have to report about the consolidated statements, but they must see whether the subsidiary statements are properly done and whether they have been received. Then accounts are in agreement with underlying accounting record. So you remember the way that we prepare financial statements, we enter all the transactions in the ledgers and then we extract the trial balance, and from the trial balance we prepare the financial statements. So your financial statements must be along with the trial balance and must be with the ledger balance. You can't have one set of ledger balances and another set of financial statements. Some people, they do. For tax purposes, they have a separate set of accounts, but for trade unions, they have a separate set of accounts. That kind of thing is not right, not ethical, not legally correct, and therefore the accounts must be in line with your accounting records that you have maintained. Proper accounting records must be kept. The general ledger, your vouchers, your payments, your receipts, your bank reconciliations, all must be kept. So the auditors must see whether those things are there. Information and explanation have been received. Auditors have a right to meet anyone and everyone in the organization, from the chairman downwards to the CEO, to any director, any employee, and to ask any explanation, any information. No one can tell the auditor, look here, that is confidential, we can't give you. Auditor has right to get any information. That's by the law. Auditor is given that right, and therefore he has a duty to get all the information and explanation what is necessary for him to give that opinion on the financial statement. And finally, the directors give a report with the financial statements and he must see whether the director's report is consistent with the financial statement. Say, for example, the financial statement shows a loss of the company, and if the directors are saying that, we have made a profit, something, that is not consistent. So, in other words, the auditors must even go to the director's report and see whether it is all right. So, when you look at all those, we have this word rapid coming up, returns from branches, accounts are in agreement, and proper accounting records are kept. That means everything together is what we call wrapping.
Okay.
So these are, so I will send you the slides. We will have these things. This will be very useful. What are the rights? So we discussed the auditor's duties. What are the rights of auditor? Auditor's right is to access to accounting record. Any accounting record he has access. Access to information and explanation necessary. He can call for any explanation. You don't need to be financial explanation. It can be about any explanation. It can be about recruitment. It can be about procurement. It can be about management. They can get asked, and they are the right to get any explanation. And since the financial statements are discussed at the annual general meeting or where the shareholders come, they have a right to attend the meeting, receive the notice, and also speak at the meeting of the shareholder. Auditor can get up and say whatever he has to say about the company in that meeting. So he has the right to receive notice, to speak at the meeting, and to attend the meeting of the shareholder. Rights related to their removal, resignation, and retirement. The auditors, you cannot just sack the auditor unless there is some very good ethical reason why, reason why you want to remove the auditors. So therefore, the auditors have a right to find out why they have been removed and all that kind of a thing. Of course, they can resign if they find that the company is not doing proper things. They can say so and say company is very unethical, company is not complying with legal things, and they don't want to be the auditors, and they can resign. These are the things that, why should we have an external audit? What are the benefits? Remember, audit is a very expensive one, Jenny. You have to pay them.
Yeah, it's very expensive.
Very expensive. The big people in the audit firms make big money because they send some trainees and juniors to do the audit. They get a very small amount, but they charge a big audit fee. The partner will just come and sit for 1 hour, 2 hours, just go through the papers, but they will charge a big audit fee. Right? So I did chartered before doing CIMA. So I was an auditor. That was my best time in my life, I think. Just as a young man, right? We are
You made loads of money.
Yeah, not only money, there lot of freedom at that time, because the time that when we were working, they didn't have these mobile phones and all that. So we are told that we have to do the audit within 2 weeks or 3 weeks or 4 weeks. We know we don't need 4 weeks to do. We can do it in 1 week's time. So 3 weeks, we can just spend time watching movies and all the things. In fact, I found my wife was in the audit firm. So audit time is the best time in our life. That is, as a small man, as a junior auditor, lot of freedom during that period when you don't have too much of responsibility, because the responsibility is with the partner. You have to do the job. So, that was the best time we had it in our life. But the big people, the audit partners, they make big money because they have a big responsibility. So, finally, the companies has to pay big audit fees. So why should a company pay big audit fees? What is the big idea of that? The disputes between management can be easily settled because there's an external third party involved. Sometimes when it comes to preparation of financial statement, your finance director may say this must be treated as a capital expenditure. Your CEO might say this must be treated as a revenue expenditure. So there can be a dispute, And remember, even though the finance director is the finance person, all the directors are collectively equally responsible for the preparation of financial statements. So the CEO also has a right to say his view and to stand on his view and to say this must be treated as a capital expenditure. So in that kind of a disputed environment, the best source to go is the third party auditors. They are experts. You can find out, hey, this transaction, how should we record? So they will give us advice. Sometimes for the advice also they might charge, but you can get some advice. Whenever you want to apply for bank loans and all that, first thing they ask is your audited financial statement. When it is before audited, it is what we call draft financial statement. It does not have the same value as the audited financial statement. The moment the financial statements are audited, and when the auditor says it's true and fair, wow, that's a green light. It's like you have passed the exam. I remember I worked in a government organization, and my very first year, because the accounts are so messy and they have not prepared their financial statements according to whatever the things they had to do it, and the auditors always disclaimed it. They said these reports are not showing true and fair value. So the very first year I went, and I was there just for 2 months, 3 months. The financial statements were prepared, and they said it is not good. Last year also they have said the same thing. Year before that also they have said same thing. So it was not good. It was not good. It was not good. And it was a government institution. So the accounts has to go to the parliament. And in the parliament, when these statements are presented, when the accounts are not good, the head of finance will have to stand and answer all the MP's queries, and they will look at you like a, top class fool because your financial statements are not prepared, not proper. But the next year, somehow I managed to do very well, and finally the auditor said, yes, it shows true and fair. So it was like for me passing the exam. And I remember that was about 10 years back, 15 years back, the Prime Minister of the country said, oh, at last, the Water Board of Sri Lanka has got their financial statements passed.
Wow.
When the auditors give the report, it is a big, big star on your uniform. You can put your collars up if you want it, because that's the big thing. So, comfort to the shareholders, because the shareholders will have a kind of assurance, not 100% guarantee, but the shareholders will feel that the auditors have gone through these statements, and therefore these statements are free of error, free of misrepresentation. From the auditors, you can get lot of advice on management controls, because they are auditing not only your financial statements, they are experts, and generally these auditors, they are very well updated in the professional standards. They will go for various courses all over. So generally they are much more better updated than the staff in the company, and you can ask them lot of advice. And I think this time in the managerial case study, there was a question about a particular report the management account was preparing, and there was a big dispute saying that report is not proper and that report is useless and that report should be completely disregarded by some other people inside the company. But finally, the management case study this time, it was all about that report, and ultimately the advice that what need to be given was to get advice from the external auditor, because they can say whether this report is all right or whether it should be changed, the format should be changed, all that. Whenever, I think you all would have seen, I have seen it, whenever we have an auditor, there is it's like a fraud deterrent, right? Not that he is responsible or not that he is the watchdog to see that no fraud happens, but whenever you say that there's an auditor, people are more careful in their transactions. Even the directors are careful. Even the directors are careful because they don't want get caught to the auditors, they will not mind getting caught to some other people, but not to the auditors, because auditors can make it public and report it. So generally, whenever there's an audit happening, the chances of a fraud will be somewhat minimized. But we have seen big companies, big directors, big auditors involved in frauds, but that is an exception. Normally, it does act as a fraud deterrent. Even when you have an internal auditor, it acts as a deterrent, fraud deterrent. People are scared to do something because they know they might get caught for the auditors. They might not get caught for your accountant, but they might get caught to the auditor. And most of the time, not sometime, I think most of the time it is the law to have finance statements audited, particularly for companies. Maybe not necessary for small sole trader businesses, maybe not necessary for partnerships, but in most of the countries, including UK, the companies, private or public companies, the financial statements should be audited. Sometimes, even though it is not the law, it may be a good thing for you to get it audited, because if you want to get a bank loan, when the financial statements are audited, you have a better chance rather than taking unaudited financial statements. Taxation people will be much more comfortable looking at audited financial statements rather than looking at not audited financial statements. So these are the big benefits of external audit. But having said that one, there can be some disadvantages or against external audit. Number one, high cost of audit fee. Right? So one way that most of the companies try to reduce the audit fee is to have very good internal control systems. And if they have a good internal auditor and good internal control systems, the external audit work can be cut down to the minimum, because they can rely on your 24/7 internal audit if it's of high caliber. So they don't need to do all the work. They can look at the internal audit reports and they can do little work, less work, and to that extent, you can reduce the external audit time, and therefore you may be able to negotiate a lower audit fee. Otherwise, you have to pay a very big audit fee. So that is a big problem. This is one big problem that we face. We don't like the auditors because they will have lot of queries. And sometimes you have to go on spending hours and hours with the auditors explaining. And sometimes they don't even understand because they are academics. They don't understand the business sense of the operation. They come and try to, put their knowledge up front on us, and we are directors, we know, we have gone through the mill, we know what it is, but sometimes these fellows can become a bit of a crazy people, and lot of management time which should be spent on strategy, which should be spent on selling, which should be spent on purchasing, can be spent on audit queries. And in a small company where the directors are shareholders, now this is very important. Why do we have audit? Mostly to give an independent opinion to the shareholders. But if you and I, we are the shareholders and directors, then we may not require another independent opinion, isn't it? Right? Because we are the owners, we are the managers. So why should I need another third-party opinion? But still, for all, it may be worthwhile because sometimes you can get some good advice, but you have to look at the cost. And unless there is a legal requirement, you may think it is not necessary. So this time the strategic case study was about a company, operational case study. It was about a hotel company. It was a family-owned company. So, there was not too much of a need for external audit unless for the purpose of meeting the statutory requirements that the audit need to be done. Because the directors, hardly they could get anything out of the external audit because they were the shareholders, they were the directors, their money, they were managing. So it's like my car, my petrol, to whom should I report? So these are some of the questions you might get it in your paper, the necessity for audit. So then look at the audit process. How do you do the audit? So the audit process, shareholders, remember always, this is a famous question. I have never seen a F1 paper without this question in the paper. They will always ask who is appointing the auditor. So they will say auditors are appointed by so and so, so and so, so and so. Remember, the auditors are appointed by the shareholders, not the directors. Shareholders will appoint the auditors at the annual general meeting, and then auditors will agree with the client, normally with the directors, and what work need to be done. They know their final responsibility. They will identify the business of the client, what kind of a business, and identify what are the material risks. Now, today the audit what we do is something what we call risk-based audit. We don't try to do everything because you can't do the entire operation of the company examination. We want to see the big risky areas where the financial statements can go wrong and focus on that area. So if it's a company that is not selling on credit like a supermarket, you may not want to spend too much of time looking at little receivables in that balance sheet. But another company where you are selling big receivables, you might want to see the receivables in a detail. So the auditor will have to agree the terms and identify the client's business, that is his business, to identify the client's business, identify the risk there where there can be material misstatement. You would have seen in most of the audit, most of the audit, they look at the closing stocks of inventory very carefully, because that is one figure that is not in the ledgers. You have to count your stocks on the 31st March or 31st December, and that is one figure that can be manipulated to a great extent by many people, either to increase your profit or to reduce your profit. So most of the time.
Oh, today, Kumar.
Pardon?
Or 31st of August. Today's my year end.
Yesterday's year end. Okay, right, okay. So did they come?
Today is my company's year end.
Oh, right, okay. Did the auditors come there?
But they haven't come yet, so we need to arrange for them to come. But today is our year
end,
our financial year end.
The moment you announce, they might come for the verification of the inventory.
Yeah.
They come and physically weigh to see how you are counted, what is your system, all that, because that is one area most of the companies can make a material mistake. I remember I was working in a company, that particular, it was a one-man show. He was a 100% shareholder. So some years he tells the accountant, I want to show a big profit, so increase your closing stock. Some years he says, I want to show a smaller profit, reduce the closing stock. So that can be manipulated, and that's a very, very dangerous, unethical thing. We are not supposed to do that kind of a thing, but the auditors know most of the companies will do that kind of a thing. And also, just before the end of the financial year, now being your financial year ending on 31st, one thing that you would have seen is that cutoff. You have to see all the sales that you have invoiced have been properly taken out of your stock. It may be still in your warehouse, not dispatched, but if I've invoiced, that must be completely taken out of your stocks. So there's what they call cut-off procedure. So these are the areas where there can be big misrepresentation in the financial statement. The auditors generally have a eagle's eye. They will know that kind of an area and they will be focusing on that one. Then you have to plan the audit. You have to plan the audit. You know that you have 6 weeks time to do the audit. You have to plan it. How many people should be put? What kind of people should be put? Juniors, seniors, and all that kind of a thing. You must plan the audit, prepare an audit program, and then you will gather evidence. Once the financial statements are given to you, prepared by the accountants, but responsibilities with the directors, and then they will gather evidence, sales revenue figure, is it in compliance with the IS 80? the elements of financial statements, assets, liabilities, all that are they properly, you remember, for it to be a asset, it must be reliably measured. Have they reliably measured all that? They will have to gather evidence. They might speak to the juniors, they might speak to the seniors, they will gather all the evidence, not only oral evidence, even document evidence. Then the auditor and the senior management of the company will review all the work files. After finishing the audit, we'll review it and see whether they have missed any area. Then after that only your audit opinion will be formed. So after going through this whole process, you will have audit opinion and then the audit report is published. So this is the sequence, how it happens. So let's talk about ultimately what the auditors give is this audit report. Let's talk about the audit report. So auditor will attend the AGM and report the opinion to the shareholders. He will read that opinion what is already published and shareholders can ask any questions. He should be answered. So what about the audit report? So this is also another question that might come up in your paper. The contents of the audit report. Audit report must be always addressed to the shareholder, to the shareholders of APLC. And the report title is Independent Audit Report of APLC for the year ended 31st August 2016. It must be properly titled, properly addressed, and should be addressed to the shareholders, not to the director. Then there's an introductory paragraph which will talk about the company, which year audit, which statements have been audited. So they will say that we have audited the statement of financial position, statement of profit or loss, and all that we will say. And also they will, for safety, they will say that it is the director's responsibility for the preparation of financial statements. We know, but still the auditors want to make it 100% clear. Look here, we are giving opinion on the statements prepared by the directors. Long time back in 1970s, I remember most of the time the auditors prepared the financial statement because the company did not have proper people. We prepared the finance statement and we were giving the opinion, which is not right, which is not correct. They must be prepared by the company and the auditors will give the opinion. Then they will give the scope of the paragraph, what and what work they did. So they will say we have done it according to the international auditing standards. There are certain international auditing standards and that we have taken reasonable assurance and care to see all that. They will say how they did. Finally, the opinion. That is what matters mostly. So the opinion is the ultimate thing. And finally, signature and date. Now the auditors, they don't sign saying Kumar Fernando. They sign using the firm name, PricewaterhouseCoopers, KPMG, Ernst and Young. So the partner will sign not as Kumar Fernando, they will sign it as KPMG and Company. And the very important thing is the date, because that date is very material. If you sign something up to that date, whatever that happens, you also have a responsibility. If anything happens after that, you can say, look here, my audit date report is dated 15th of September. This has happened on the 20th September. I'm not responsible. But if you don't put a date, you have a problem. So these are the important things in the audit report. So now we will talk about the audit report types, what we can have. So the audit report types, what we can have it is, there are two ways. We can give an unmodified opinion or a modified opinion. Remember, we are giving an opinion. The opinion can be an unmodified one or a modified one. Unmodified means where the audit is 100% satisfied that everything is super free of mistakes, and they will express an unmodified opinion. In other words, they will say it shows true and fair view of the affairs. they have nothing to modify. They believe everything to be 100% right. And that is what the dream of any finance manager, dream of any directors, to get an unmodified opinion from the auditors. Of course, you have to be ethical. You can't take the auditor to a restaurant, give him a dinner and get him to give a unmodified opinion. That type of thing is not acceptable. But without any prejudice, without any bias, if he gives an unmodified opinion, that's the base. So when I got that audit report unmodified, the Prime Minister himself put his hands on my shoulder and said, good job done. So, unmodified opinion. That is very important. If it is not so, if the auditors can't give an unmodified opinion, he might give a modified opinion. Modified opinion is given when he decides he can't give a totally unmodified, and the reason, there are two reasons. When the financial statements are not free from material misstatement. In some area, the financial statements, the auditor may feel, he may be of the opinion that the stocks are not properly valued or receivables are not properly stated, that there are so many bad debts but which is shown in the receivables as receivable, and therefore it is not free from material misstatement. In that case, it will be a modified. And otherwise, when they have been unable to gather sufficient appropriate evidence, you can ask, can I have the vouchers for this? The director says, very sorry, we don't have vouchers. Can we have the contract we have signed for this construction? We don't have. So in that kind of a situation, when they don't have good evidence, they will give a modified opinion. So these are the reasons why they can give a modified opinion. The modification, when you give a modified opinion, there are three types of modified opinions. Right? So the modified, unmodified, no problem. But for these particular two reasons, they can give a modified version. Modified version can come up in three types. So three types of modified versions is basically, number one, it's a qualified opinion. You say the financial statement shows true and fair view except for the inventory valuation. Or the financial statements show true and fair view except for the contract with such and such company where we have not been able to see the agreement or the contract signed. Or they might say it's true and fair except or subject to or except to receivables figure which we feel is not properly reflected, something like that. That is what we call a qualified opinion. Second one is an adverse opinion. That is where there is lot of material and pervasive misstatement. It is not in one area, but in many areas there are material errors. So you can't say except, because there are so many exceptions, and then in that case you will give an adverse opinion. So where you simply cannot say, it's only one particular area, 2, 3, 4, then you say adverse opinion. Third one is the worst one. It's so bad, you say, we are very sorry, we cannot form any opinion. So that is, you don't have enough evidence, you don't have sufficient documents, nothing, and simply you can't do anything. You just say, we disclaim the financial statement. The place I was working, the National Water Board, the first year I worked, that was the report they were getting, a disclaimer. Disclaimer. Wow. And for 6-7 years, they have been continuously, the auditor has been given a disclaimer, and the auditor of the government institutions is the Auditor General of Sri Lanka, is the government auditor, and when he says disclaimer, no way out. You have to just resign, not only resign, you will have to just, get out of your country also. So my predecessor probably has not done enough, and when I came and when I prepared the first statement under my control, and when it said they were going to give me a unmodified opinion, that was super. Right. So these are some things what you need to know all the time. So modified also, I just put a little table for you, which is very useful. Auditor's judgment about the matter, material but not pervasive. It's material, but it is not spreaded. Material and pervasive. Material and spreaded, it's all over. So financial statements are material misstated, then you can give a qualified opinion. If it is material and pervasive, adverse opinion, unable to obtain sufficient evidence, qualified opinion or disclaimer. So this is a little bit of a chart for us to know, but so long as you know basics, it's all right. So basically, sometimes the auditors will try to draw the attention to matters already disclosed in the financial statements, but the auditor feel it must be further emphasized that for the understanding. So maybe sometimes the directors have said that a particular customer is going for bankruptcy and we may not be recovering the amount due from him. But the auditor might feel that is not good enough. You must emphasize, because it's a big amount. If that goes bankrupt, your financial statements can be somewhat completely out, and they might say that there is a kind of an emphasis needed. So there are three circumstances where an emphasis of matter is appropriate. When there's uncertainty about an exceptional future event, you have already signed a contract to do some work, but either that party is not ready with the work, but you have already invested a lot of money, and that is something which you, as the auditors, you may have to emphasize, because the shareholders should know that the company has already invested money, but the contract may not come right. Early adoption of new accounting standards. Now, whenever the accounting standards are issued, generally it is told it is effective from, say, they give about 2 years grace period for you to implement it. So I think there's a new IFRS 9 coming up in 2017. But it was issued in 2015. People have the option to adopt it earlier. You don't need to wait till 2017. You can adopt it. 2017 you must. But before that, if you are capable, you can. In that case, you must say, the auditors must emphasize that the company has already adopted IFRS 9, even though it need to be adopted only in 2017. So I know a lot of companies have adopted some of those IFRSs which can be applied in 2018, but already they have adopted, which is good. When a major catastrophe had a major effect on financial position, something like a big fraud, something like CEO leaving and some big payment to be made, some big cases coming up, that kind of a catastrophic effect thing should be shown. So this is simply all about the external audit. EOM can come only matters on already disclosed in the financial statement here. Auditors can't go out of the financial statement. Auditors can give opinion on the financial statements. Anything in the financial statement where they feel more emphasis should be given, EOM can come. If directors have not disclosed matters, then if the auditors perceive are materially misstated, they may modify the opinion. So, if the directors have disclosed, you might think of emphasizing. If the directors have not disclosed, you can't emphasize, you have to modify your opinion. That we come to the end of the external audit. So that is one area, because I think this is the only paper they will test us, but maybe in the F2 they might put up certain questions, and particularly this will come up in your case study when you are doing the case study. Next topic we are going to look at is a very, very important one. This topic, never ending, ethics. It will be in F1, it will be in P1, it will be in F2, it will be in P2, it will be in F3, P3, E3, from the
It's in everything.
all over, from the beginning till till the day that God calls us, we have to, as SIMA members, we have to be subject to ethics. You would have seen in their magazine, sometimes there are a lot of people being suspended, removed from the membership for being unethical. So ethics is something that we have to keep it, and your exam, your these papers you will have it, your case study papers you will have it, if the managerial level papers will have it, your strategic level will have it, every paper will have ethical points, ethics being discussed, and this is something SIMA is very, very focused about the high ethical standards. So let's talk about ethics in a way. So actually I do this slide for P1, P2, P3, F1, F2, F3 all, and even for the case study, because there's nothing more to be added even at the level at the higher levels. Same story.
Okay.
Let's talk about ethics. So ethics is simply, we know that all of us know the law, the legal boundaries. We will somehow see that we will maintain within the legal boundary. But as SIMA members, as professionals, we have to go beyond the legal boundary. We have to be responsible corporate citizens, and we have to get guided by certain moral principles, our behavior. I mean, legally, you can take alcohol, you can go at a place, take alcohol. There is, unless you make a big public nuisance, legally it's not, there's nothing wrong. People go and take. But as a professional member of the SIMA Institute, if you take excessive alcohol and if you misbehave in a place, that also can be a reason for them to remove you from the membership. So,
Really?
yeah, yes, because what they say is professional behavior. Professional behavior is.
But you're not working.
Yes, whether
You're
you're
out. You're having fun.
yes, whether you're working or not, you must maintain the SIMA membership dignity. That's what they say. So if you get involved in a fight or something like that, if SIMA comes to know that you have publicly fought, not a fight between the husband and wife, but if you have had a fight with some outsider and a public something, and if it has, if it is reported and saying that you are a SIMA member, the institute can take action against you.
Wow. Okay.
So SIMA is very, very strong on the code of ethics. I suppose, that's the way they have brought that type of a discipline to the membership. So as SIMA members, wherever we work also, we have to bring and implant that kind of a moral behavior. And also, today, we have found any unethical behavior, if you are caught up, it is a source of a risk. People will not want to patronize your company if you are into some unethical way of doing things. Today I got some vegetables, I ordered the organic vegetables because here we have this all chemically fertilized thing. So for a change, I ordered some organic vegetables. When the box came, I saw in the box they have said fresh, ethical, and environment friendly. Fresh, ethical, and environment friendly. So I was thinking ethical. The food that they are selling, the vegetables they are selling, is meeting the ethical standard, because today we see legally there is nothing wrong in applying this chemically processed fertilizer. But we see the society, so much of diseases, so much of sicknesses, all that when you finally analyze, it is the food that we eat with all sorts of this artificial fertilizer. I paid the
Right.
ultimate price. My daughter finally passed away with the kidney problem, and probably the food that we were eating could have caused to a great extent all the sickness for her, because
Yeah.
we are not eating the kind of food. So today for a change, it's very expensive, but I got some organic food and I told my wife, try and manage this kind of thing, because we find that lot of arsenic, lot of things in this food and water that what we consume. And people
Yeah.
are
I
increasing.
don't eat meat, so that's good.
Pardon?
So I don't eat meat. That's good as well.
Yeah,
To don't
definitely.
eat meat.
Yes,
Yeah.
yes, yes. Yeah, we try to eat lot of vegetables nowadays, and
Yeah.
work to that part, because we find all sorts of sicknesses come through these meat and that kind of thing. So the people are becoming environment conscious, people are becoming ethical conscious, even though society is somewhat unethical, society is greedy for money, business people are greedy for money, they will do lot of unethical things, but still for all, people expect the society to be ethical. And if you get caught doing something unethical like employing child labor, or exploiting your supplier, paying lower prices, or delaying his bills, or whatever it may be, unethical practice. You may not be illegal, right? You take, from me, I'm a poor farmer, you take on credit for 60 days, but you take 120 days to pay. Legally, there's nothing wrong in what you do, because, so long as you are going to pay, the court will say it's all right. But how ethical it is for you to have money in your bank account and not to pay the poor farm. So that kind of a thing is what we call ethics. So ethics are something what is not a piece of law or not piece of regulations, but the way that your conscience speaks to you and to the organization. So unethical behavior by one or more participants can be unethical, and mostly these unethical things happen in the government business, particularly in the developing countries. If you want to do business, you have to give big money to these government ministers, government officers. That's the way they get the business. And that's why the Chinese are so smart. They know exactly where to tap, how to get the people and to do the business. Western people, country like UK, country like USA, they are somewhat behind because they don't do too much of unethical things. But whereas Chinese and some other nations, they are up to, grab business, whatever the way they will do it. So in the government business, particularly in procurement, these things happen, and also failure to maintain confidentiality. You and I, whenever we are in business, we come across certain what we call business secrets. My son was working in the Standard Chartered Bank, and he was handling the bank accounts of all the big cricketers of Sri Lanka. Here the Sri Lanka cricketers are one of the rich breeds. So he was handling all the bank accounts, and he knew exactly the bank balances of all the top Sri Lankan cricketers. So sometimes my wife used to ask him very casually, how much balance is Kumar Sangakkara must be having in his account? My son is totally dumb at that time. He won't speak a word even to his mother, because he's under code of under code not to disclose any of those information. So we come across a lot of information. We have to maintain confidential. If we don't maintain, that means we are unethical. The hoteliers particularly, they will know the sometimes the Sri Lankan Prime Minister, the UK Prime Minister, they want to take a little break. So they want to be away from the people. They want to be at a particular resort or something. They don't want anyone to know where they are. But the reservation manager will know, the reservation girl will know, and so is coming because they are doing to make the security arrangement, and then they can just go and say so and so as is in our hotel during the weekend. That can be a very unethical thing. So suppliers, about not allowing the suppliers to compete on equal terms, giving some favorable thing because your sister-in-law is working there, your brother is working there, giving him some advantage, those are unethical things. So ultimately, if you do this kind of a thing, it is a matter before long where your reputation suffers. That is why SEMA is very focused on ethics. You must maintain your reputation all the time. So, talking about the types of corruptions, we know today there is so much of corruption with all the ethics that we are talking about. Bribery is rampant. Bid rigging, when there's a tender, people will try to find out the lowest price what the other man has put. When the tender is closing at 12 o'clock, at 11:59, some fellow will come and put up a bid because he knows all the other figures. So that kind of thing, money laundering, then human trafficking is happening at a very big level all over, people using the humans as a shield to take things like narcotics, all that kind of a thing. So these are all happening. And now the latest one is cyber security, hacking.
Yeah.
Hacking our website. Sri Lanka president's, our president's website was hacked yesterday by a 17-year-old boy, brilliant boy who had done the O-levels, eight A's, 17-year-old boy, and a 27-year-old young graduate from the best university in Sri Lanka. Both the fellows have got together and they have hacked the president's website, and they have deleted certain information, they have inserted certain information, they were arrested, and today I saw in the Facebook, two young fellows, they were arrested, and today I saw a lot of articles in the Facebook saying President must employ those two fellows and sack all his IT people because those other IT people have not been able to protect his IT system.
I agree.
Yeah.
I agree.
Yeah, and these two fellows, such a clever two fellows, they must not be sent to jail. They must be properly used.
Used to
Yeah.
protect, to protect.
I just endorsed it. So I hope, that, the authorities, because sending them to jail, I think is a crime. Because brilliant brain,
Yes.
So today these things are happening. The cybersecurity is a big thing, big money, $1 million money. People are doing these things, and people spend money to do all these kind of things. So this is happening all over. Most of our ethical issues arise due to internal failings. Now I want you to understand this one. Mostly it is because we have not told our employees what our ethical standards. So there was a question, I think in P1 or P3, I can't remember. One man was sent to another part of the world to canvass a particular government business to supply computers. So he went, he got the order. So let's say the figure was, the figure that we want to quote was 10 million, but he went and negotiated and managed to get not 10 million but 15 million figure. But the agreement was we must give that government high officer 2 million as a bribe. So instead of getting 10 million, you are getting 15 million, not a bad deal. Out of 15 million, you have to give 2 million. So you are better off by 3 million still doing the deal. So this man was very happy. He came back and he reported to the board of directors. He came very happily and said, I got the deal for you all. You all wanted 10 million. I got it for 15 million. But one condition, we had to put 2 million to a particular undisclosed account in somewhere in one particular government officer's name. The board got furiously mad. The board said, didn't you know that we don't tolerate that kind of a thing? Employee's reaction was, employee said, you never told us. Right? You never told me that our company is not tolerating that kind of a thing. So that is why we must have a code of ethics, written code of ethics for our organization. People must know what they should dress to the company, how they should behave in the company, what is confidential information. All that people must be told and people must be properly trained. Most of the time, the failings happen because of this excessive bonus culture. We say you achieve a target so much, you will be given a bonus. If you can double the target, you will be given a double the bonus. People go and do mis-selling. They try to bluff the customer, giving all sorts of lies, and they try to sell it because they want to get that bonus. So that kind of thing is also not proper. Bonus culture. These are our internal failing. Lack of clarity on company on entertainment expenditure, political donations. Sometimes we are told you can spend so much on expenditure on entertainment, but they don't say on whom can you spend. I had one of my friends, every month, end of the month, he used to take our family, his family, to a 5-star hotel and entertain us very well. So we was very happy because it was good friendship for us. But later on, he lost his job, and finally when the inquiries came, what they found was that his entertainment allowance was spent not on the clients but on the friends and the relations. Unethical. We did not know that he was spending out of his company entertainment allowance, but totally unethical. Political donations. You give a political donations with a view to get some business when that party comes into power. Lack of clear financial control. When you don't have proper systems, when you don't tell budgets, when you don't have budgets, people can spend anything, everywhere, all that kind of thing. I remember I was working in a particular company. We had to pay certain taxes. I was very worried because it was too much of taxes to be paid. I didn't have money to pay. So I went and told my managing director that he was one-man show. I told him we had to pay the taxes. He said, don't worry. You don't need to worry about the taxes. I will look after. So I asked him how he is going to look after. He said, you don't need to worry. You will not have to pay taxes. I will look after. And later on, what he had done is he has called one of my accountants. He is one of his relations, and has told, take some gold jewelry, gold bangles, go and meet the lady income tax officer, give her the bangles, and see that the file is closed. So simple. So simple. So this my boy has taken the bangles and I gone and met this lady officer. The lady officer has told, look here, I have enough bangles. I'm sure that, all the people would have been giving her bangles. She has told, I have enough bangles. I don't want bangles, but can you ask your boss that I need so much of money to put up a house? Can you ask your boss to give that money? I will close the file. We have to pay 20 million taxes. That lady has asked 2 million money to put up a house, and by giving the 2 million, the file was closed. So that's corruption in this part of the world. Totally unethical. I thought I will lose my membership if I stay there. So I said, very sorry, I can't stay here anymore. I left that company just like that because I knew if I stayed there, whether I have participated or not, I will be responsible for those unethical acts. Lack of clear anti-bribery message. That company earlier in that exam, the top level management did not say that we are totally anti-bribery. It must be told. We know we are supposed to be anti-bribery, but it must be told. If you look at this Asian Development Bank, World Bank, and many of the multinational companies, in their annual reports, they say exclusively, they say, we will not entertain any anti-bribery or any bribery solicitation or anything like that. So then gender the kind of gender discrimination, racial discrimination. These are all unethical things, and these are all what can happen internal failings. So you have to think how we are going to manage these. What are the poor ethical consequences? If you don't manage your ethics well, one thing you will happen is you will have suppliers and customers. Most of the people will not be willing to deal with you. You will find difficulty to recruit good staff, particularly the CIMA students. CIMA members will never join a company that is having some unethical records in the past of a particular company. Fall in demand for product due to consumer boycotts. These people will not want to buy these products. Recently, I saw in the Facebook a particular organization in Sri Lanka. They have been up to some mischief, doing some unethical things, abusing their employees. I mean, something like same-sex kind of thing happening. And immediately when the people came to know about it, they stopped patronizing that restaurant. And I think they have closed down the business. The consumers decided not to patronize that business. It was a 118-year-old company. But there was articles saying that the senior male staff abusing the junior male staff and in a sexual way. And the moment it came, the people started, stopping going into that restaurant. I was passing it is a big restaurant chain. I was passing and then I saw that things are not working because normally you see so many cars. Then later on I came to know that they have lost business and the people are no longer patronizing. Whenever these things happen, one thing, the media will really expose you. You have to be very, very alert, agile to the media. And when they start exposing, you have to counterattack. This is all your case study most of the time. And when those things are to be done, you have to spend more money on public relations. Whenever you're caught up on this kind of a thing, the regulators, the tax authorities will be scrutinizing your statements much, much more carefully than the other people. So you have to be very, very concerned and you have to spend more money because you will be subject to more scrutiny because you are a kind of a blacklisted kind of a entity. Your share prices will drop because the people will not have too much of confidence in you, and all these things can happen to your organization. What are the responses to reputation? Now this is a very interesting question most of the time. Whenever we find that our company is being exposed, saying that we are using child labor or that we are entertaining suppliers who are using child labor, or we are exploiting our suppliers, whenever that kind of a thing comes up, one way is we can just ignore. But that is not a very effective way. We should never ignore. You must address the issue. If we are guilty, admit, yes, we have been wrong and we will never do it later on. And see whether we have a way of compensating. You remember Toyota, they had a product defect. They took long time to recall the vehicle, and by that time it was considered unethical for them to know that the particular vehicle model was not doing well and to wait too long, and ultimately they had to pay a big penalty. And I think recently Volkswagen, they had a problem. They gave certain emission reports on the test sample, but the actual vehicles had a higher emission, and those kind of things can be very, very unethical. And if you come to know, you must admit it. Don't ignore. This is always SEMA question. You have options. One thing is to just to ignore and wait, but that's not a way. you have to look at the ethical issue and see what action we need to take, whether it should be done, or that kind of a thing. You must be always endeavor to be transparent. That is what you should be. Impact of ethical failures on stakeholders. Stakeholders are the people who have interest in your company. So there will be some people who have a direct claim, like the shareholders. Some people, they have an indirect claim, like the environmentalists. They speak on behalf of the animals, the birds, and all that kind of a thing. And therefore, you have to look at who are being impacted and recognize their rights and meet their rights. So, shareholder claims. Know that the shareholders have a claim and look at their power and interest to the Mendelow's matrix, high power, high interest, low power, low interest, and do that one.
Is that Mendelow's one? No.
Pardon, you remember the Mendelow's?
Yeah.
That is, there are 4 categories of people we find in an organization or people interested in the organization. We have the high power, high interest. They are the people we have all the power and who are interested. The board of directors, the senior management, the major shareholders come under that category. So their interest, we should never compromise. Whatever their interest, we must see it is properly made. Then we have high power, low interest. They have the power, but they don't have too much of interest like the government, like the banks. They must be keep satisfied all the time. Then we have low power, high interest, like the unions, like the employees, low power, high interest. We have to keep them informed, and that's all we have to do it. Then we have the low power, low interest. The people they don't have too much of power, they don't have too much of interest. That people we don't need to worry too much. Minimal effect. So stakeholders will have different stakeholders. We have the internal stakeholders, you have external stakeholders, you have connected stakeholders, legitimate and illegitimate. So legitimate stakeholders.
I've never heard those two before. These are 2 new ones, legitimate and illegitimate.
Yeah, these are new ones. That's right. Because there was an article in one of the SEMA long time back, about 5 years back. They spoke about hundreds of stakeholders for a company, right? Illegitimate stakeholders, who are they? They are these terrorist groups. You know, they are also interested in your company because sometimes they ask for ransom money when you make a profit, right? So I remember I was working in a company where we had a civil war in the north part of the country, and that was under terrorist control. But super economic activity, business was flourishing in that area, but the government did not have any control. The terrorists were controlling that area. So if you want to do business with in that area, you have to pay taxes, which is illegal, but you have to pay taxes to those terrorists. Then only you can enter those areas and sell your product. So I remember one day one of those terrorists gave me a call and asked me, they want to have my financial statements because they want to see my profit. And according to the profit, I will be taxed, and I have to pay taxes if I want my lorries to go there. These are what we call illegitimate stakeholders. They don't have a legal claim, but still they are interested in our company's activities. Then we have the direct stakeholders, indirect stakeholders. So the list goes on. Even the examiner said the fish on the sea, the trees on the garden, they are stakeholders. They can't talk, but some other people will talk on their behalf. Yesterday when I went for the walk, I saw the lagoon that nearby, most of the fish has died there. So I asked them why, what happened, because they have done some cleaning, and suddenly the water has got disturbed and a lot of fish have died. So they also have a right to live in this world. Safeguard against unethical behavior. This is where the SIMA comes up. SIMA has a code of ethics. You have to remember the 5. Number 1 is integrity. We must be always totally honest and truthful. Not only we don't tell lies, we don't even suppress the truth. Then we have to be what we call objective. We are not intimidated, neither we have a self-interest. We will not try to do something to please someone. We will only do what is right and what is right. Then we should be people who maintain confidentiality. The business secrets we will not discuss with anyone. We will keep it to ourselves. Then professional competence. If we are not competent to handle, we must not handle it. We must say, sorry, I don't have that knowledge and I will gather that knowledge. That is why SIMA, even after you pass the exam, you can't just rest. You have to do what we call continuing professional development, what we call CPD. I'm 60 years old. I still can teach the students of 2016, even though I did my exams in 1980s, because I kept myself updated with everything what is happening. Most of my colleagues are completely outdated because they have learned it in their time and they can't. And they're completely out of context when it comes for today's modern business environment. So SIMA wants us to keep updated all the time on the CPD that thing. So that is what we call professional competence. Finally, but not the least, professional behavior. We must behave on and outside the office, on and off the field in a manner that it will not bring any degrade to the SIMA Institute or SIMA qualification. So that is why when we have this SIMA membership, we have to be extremely careful how we behave, how we talk in the public. All that can be somewhat be considered unethical, and action can be taken. So safeguard against unethical behavior is, if you are a person working in a company, if you see something happening unethical, you can say, I'm sorry, I can't participate in this because I'm a SIMA person and I'm under SIMA code of ethics. So this is a safe work environment. So we can say, you can look at the following safeguards. Always you have to see good recruitment procedure, get the right people, have strong internal controls, disciplinary procedures. Leadership must be very supportive of ethical behavior, monitor the employee performance, ensure that everything is communicated to them. So that kind of a thing will have a good, proper ethical environment for you to work. And finally, if you find something, you must talk to a colleague and find out whether this particular scenario is all right or not. If you are in practice, if you are doing auditing, that kind of a thing, you must be always subject to discipline. You must rotate your staff all the time. Don't allow the same staff to do the audit all the time. Have good quality control audits, all that what we discussed earlier. So the audits must be done with that kind of. You can have ethical conflicts. This is a famous examiner's question. 5 ethical conflicts. One is what we call advocacy. That is, you try to, just because he's your boss, it is wrong, but you want to support him on a wrong matter and you say it is right. When the wall is black, you can see pure black, but you say it's white, 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 because you want to, entertain, support your boss, which is not right and which is not reasonable. Self-interest, sometimes we do things for our own interest. We are going to get a bonus. So because of that, we will prepare financial statements in a different way. There can be a lot of pressures coming, that kind of a thing. Intimidation, it's all about pressure from your immediate boss, CEO, saying, Jenny, prepare these statements this way. If not, you will not have a job tomorrow. Familiarity, it's all about having your own relations, and therefore you want to be, flexing the things here and there. You are not totally independent because your sister-in-law is working. You are doing the audit, and you will just have a blind eye, that kind of a thing. Self-review, sometimes you try to do everything by yourself without help getting the others to check on your work. These are what we call the conflict. So finally, CIMA Code of Ethics, as I said, these are the main 5 principles of Code of Ethics which we need to keep up all the time, and this is what is expected of us. So we managed to get up to that point, but we had to do the corporate governance. That's one area which we could not do within our 6-hour plan. That's all right. So we can do it whenever we meet next. How is your program next week?
You mean for Sunday?
Yeah, Sunday we are meeting, no?
Yes.
That is,
I just haven't done much revision, so I need to go over my revision.
Pardon?
As I said, I just haven't done a lot of revision from what we've done previously because I've been so busy with work.
Okay,
so
no problem. Yeah. Just try to
Has it been 6 hours already?
I think just a minute. Yeah.
Because I don't think it's been 6 hours already.
Hold on. Yeah, it is 6 hours today. With today is 14, 17, 21st, and with today it will be 6 hours. 4 days.
When was it? What day was it?
14th of August, 90 minutes.
Yeah.
17th of August, 90 minutes, taxation, both funds.
Yeah.
21st August, the conceptual framework, 90 minutes.
Yeah.
And 31st August, today, 90 minutes.
Wow, that went really fast.
Yeah. Yeah. So the 90 minutes is gone. The 6 hours are gone.
Yeah. So I'll top up tomorrow.
That's all right. That's no issue. Tell me the day. We are normally we do it on. That is 9:30. Is Sunday we do.
Yeah.
9:30, no?
Yes, 9:30. Yeah.
And Wednesdays we do it at 7 o'clock. So it's all right. So
yeah, I think 7:15 is probably better because
no problem. 7:15 is all right.
Trains, yeah.
Yeah, I can manage.
7:15, yeah.
I can manage 7:15. No problem. Don't worry about that. So we will meet on 9:30.
Yes.
Okay.
Yes.
Okay, Jenny. Take care.
Okay.
Bye. Okay.
Thanks,
Bye.
Kumar.
Bye.
Bye.
Bye.